There is a profound and deceptively simple question that separates the masters of the investment world from the millions who try and fail. It's not about predicting the future. It's not about complex algorithms or insider information. It's a question of where you choose to fight your battles. Most investors, driven by a desire for spectacular returns and the thrill of the hunt, actively seek out the most difficult challenges. They look for broken companies, for dying industries, for corporate shipwrecks lying at the bottom of the market, and they dream of being the hero who can single-handedly raise the vessel from the depths. They are drawn to what Warren Buffett calls 7-foot hurdles. Problems so complex, so entrenched, so demanding of heroic effort that attempting to clear them is an act of breathtaking hubris. They chase turnarounds, they hunt for cigar butts, and in doing so, they sign up for a game of low probabilities, high stress, and, most often, catastrophic financial loss. But Buffett, the grandmaster of this game, plays an entirely different sport. He is not a corporate surgeon performing triple bypass heart surgery on a failing enterprise. He is a shrewd buyer of masterpieces that have a single, tiny smudge on the canvas. He doesn't look for 7-foot hurdles to leap over. He actively searches for 1-foot hurdles he can gracefully step over. This single, foundational principle is one of the most powerful and misunderstood secrets to his multi-decade reign as the world's greatest capital allocator. He invests in wonderful businesses that are facing simple, temporary, and easily solvable problems. This philosophy is a paradigm shift. It transforms investing from a high-stakes gamble on resurrection into a high-probability exercise in patience. It's about buying excellence at a discount, not mediocrity at a bargain. It's about understanding that the greatest returns don't come from turning a bad business into a good one, but from buying a great business when a wave of irrational fear, a temporary misstep, or a solvable crisis makes it available for a fair price. Today, we are not just going to talk about this principle. We are going to deconstruct it, reverse engineer it, and build it back up into a mental model that you can apply to your own financial life, to your own portfolio management, and to your executive decision-making. We will explore the very anatomy of a 1-foot hurdle, contrasting it with the siren song of the value trap. We will learn how to identify bulletproof quality before a crisis ever hits. We will master the psychological temperament required to act when everyone else is paralyzed by fear. And finally, we will understand how this simple investing approach unlocks the most powerful force in the universe: long-term, uninterrupted compounding. This is not just another piece of financial education. This is a fundamental alteration to your investment strategy, a recalibration of your entire approach to risk management and capital allocation, designed to help you stop chasing miracles and start making methodical, high-probability bets on predictable excellence. Let's begin by dissecting the very essence of this idea. What, precisely, is a 1-foot hurdle? It is a problem that is external, temporary, and non-fatal to the underlying business. It's a dark cloud, not a terminal diagnosis. To truly understand this, we must travel back to a moment of crisis, a time when one of America's most trusted brands was brought to its knees by a scandal so bizarre, so audacious, it sounds like something from a work of fiction. This is the story of American Express and the Great Salad Oil Scandal, and it is perhaps the single greatest foundational anecdote for understanding the anatomy of a 1-foot hurdle. The year was 1963. American Express was the undisputed king of travelers' checks, a symbol of trust and security for Americans abroad. Their brand was sterling, their business model a fortress. They had a side business, a warehousing division, that was seen as a stable if unexciting part of their operations. This division issued receipts for commodities stored in its warehouses, and these receipts were then used by the owners of the commodities as collateral for bank loans. It was a simple, trust-based business. But in a grimy corner of Bayonne, New Jersey, a man named Anthony Tino DeAngelis was running a massive scam. DeAngelis was a commodities trader, the self-proclaimed king of salad oil. He leased a massive tank farm from American Express's warehousing subsidiary. He claimed to be storing hundreds of millions of pounds of soybean and cottonseed oil, salad oil, in these tanks. He took the warehouse receipts issued by American Express and used them to secure over $150 million in loans from more than 50 different financial institutions. That's over $1.5 billion in today's money. There was just one problem. The tanks were mostly empty. Tino DeAngelis had devised an ingenious system. The tanks had pipes that connected them, and when inspectors would come to measure the oil levels, his men would frantically pump the small amount of real oil they had from tank to tank, just ahead of the inspectors. For the tanks they couldn't reach, they simply filled them with seawater and floated a few feet of salad oil on top. The inspectors, dipping their measuring sticks from the top, were none the wiser. The fraud was epic in its scale and simplicity. Then, in November of 1963, the music stopped. Tino DeAngelis's company, Allied Crude Vegetable Oil, defaulted on its loans and filed for bankruptcy. The banks, holding worthless warehouse receipts, turned to the guarantor, American Express. Wall Street was thrown into a state of absolute panic. The headlines were brutal. American Express, the bastion of trust, was implicated in a colossal fraud. Its liability was estimated to be as high as $175 million, a figure that exceeded the company's entire net worth at the time. The stock collapsed. In a matter of weeks, it was cut in half, falling from over $60 a share to $35. The finest minds on Wall Street declared American Express a dead company walking. The fear was palpable. The narrative was simple and terrifying. Amex was bankrupt. This, for the 99% of investors, was a burning building to be fled from, not run towards. But for a 33-year-old Warren Buffett, sitting in his small office in Omaha, this was the faint, beautiful music of opportunity. He didn't see a burning building. He saw a fortress under a temporary and localized siege. He began his investigation, and what he did next is a masterclass in stepping over a 1-foot hurdle. He didn't build complex financial models. He didn't try to predict the outcome of the impending lawsuits. He went out and did field research. He visited restaurants and banks. He talked to cashiers and customers. He was trying to answer one simple, crucial question. Did the salad oil scandal, as terrifying as it was, actually damage the core businesses of American Express? Had the fraud in a New Jersey tank farm tarnished the global trust in their travelers' checks? Had it convinced people to stop using their credit cards? What he found was the opposite. Customers were still using the travelers' checks. Merchants were still accepting the credit cards. The fundamental competitive advantages, the powerful brand, the global acceptance network, were completely untouched by the scandal in the warehousing division. The problem, while massive in dollar terms, was contained. It was a wound, a grievous one, but it was on an arm, not in the heart of the business. Buffett concluded that the company would survive. It would take a financial hit, a huge one, but the core earning power of its primary businesses was intact. He saw the 1-foot hurdle. The hurdle was the financial liability and the reputational stain from the scandal. But the ground on the other side of the hurdle was a magnificent, world-class business that was now being offered at a ridiculously cheap price. So he acted. He allocated a staggering 40% of his partnership's capital, around $13 million, to buying shares of American Express. It was the single largest investment he had ever made. He was betting the farm on his analysis that this was a temporary problem affecting a great company. Over the next few years, his thesis played out perfectly. American Express settled the lawsuits, took the financial hit, and eventually shut down the warehousing division. But the traveler's check and credit card businesses continued to grow and gush cash. The market's panic subsided, and investors once again recognized the incredible quality of the underlying enterprise. The stock price soared. Buffett's investment turned into a massive multi-bagger, a home run that helped cement his reputation and build the foundation of his fortune. The salad oil scandal was the perfect 1-foot hurdle. It was big, it was scary, and it was public. It created mass hysteria. But it was not a problem with the core business itself. It was an external event, a costly mistake in a non-essential division. The solution, while painful, was simple. Quantify the damage, pay the bills, and move on. Buffett didn't need to be a hero. He didn't need to engineer a turnaround. He just needed the clarity to see the fortress for what it was, and the courage to walk across the bridge while everyone else was convinced it was about to collapse. The reason this simple investing approach is so effective lies deep within the wiring of our brains. The story of American Express isn't just a financial case study. It's a lesson in behavioral psychology. Warren Buffett wasn't just smarter than everyone else. He was operating with a different psychological playbook, one that allowed him to override the cognitive biases that lead the vast majority of investors to financial ruin. The key principle at play here is a combination of the availability heuristic and what we can call a simplicity bias. The availability heuristic is a mental shortcut our brains use, where we overestimate the importance of information that is easily available to us. In 1963, the information that was readily available was terrifying. The headlines screamed of fraud, bankruptcy, and collapse. The story of Tino de Angelis's phantom salad oil was vivid, memorable, and emotionally charged. This dramatic narrative was front and center in every investor's mind, and because it was so available and so shocking, it massively distorted their perception of the actual risk. They mistook the salacious and easily recalled story of the scandal for the full, nuanced picture of the entire American Express business. Their brains couldn't separate the noise from the signal because the noise was a deafening siren. This is where Buffett's approach diverged. He instinctively understood this bias and worked to counteract it. Instead of focusing on the available, sensational information, he sought out less available, more fundamental data. His scuttlebutt method of going to restaurants and banks was a conscious effort to replace the vivid but misleading narrative of the scandal with the boring but true narrative of the core business's health. He was overriding the availability heuristic by actively seeking out counter-information. Complementing this is the simplicity bias. Our brains are pattern-matching machines that crave simple, coherent stories. The story, trusted company betrays public, goes bankrupt, is simple, easy to understand, and emotionally resonant. The alternative, more accurate story, trusted company's peripheral division makes a catastrophic error, incurring a large but survivable financial liability while its core franchises remain untouched and highly profitable, is complex, nuanced, and requires more cognitive effort to process. The market, especially in a state of panic, will almost always default to the simpler, more dramatic narrative. Buffett's genius is his willingness to embrace the more complex, less emotionally satisfying reality. He understands that the truth of a business is rarely a simple headline. He is comfortable living in the gray area of nuance and probability, while the rest of the market is desperately seeking the black and white certainty of a simple story. This is a crucial distinction for any retail investor or entrepreneur. When you evaluate a stock that has fallen sharply, you must ask yourself, what is the simple prevailing narrative? And is that narrative truly representative of the entire business? The market often sells off an entire company because of a problem in one division, a bad quarter in one product line, or a negative regulatory headline in one country. It is taking a simple, available piece of negative news and extrapolating it into a story of total corporate doom. The one-foot hurdle investor's job is to act as a journalist, to dig deeper than the headline and find the more complex and often more optimistic truth. Buffett exploited the market's cognitive shortcuts. He used the panic created by the availability heuristic as his entry signal. He profited from the market's lazy reliance on a simplistic narrative by doing the hard work of understanding the complete, multifaceted story. He saw that the problem was contained, solvable, and most importantly, that it had almost no bearing on the factors that made American Express a truly great business in the first place. This is a mental superpower. The ability to remain objective and analytical when surrounded by a tidal wave of emotional, simplistic, and readily available information is what separates a sound investment strategy from a knee-jerk reaction. It's the cerebral foundation of buying fear and selling greed. So how can we translate this powerful psychological insight into a practical, repeatable process? How can we build a blueprint for identifying one-foot hurdles in our own investment journey? We need a mental model, a checklist to run potential opportunities through, to separate the easily solvable problems from the truly catastrophic ones. Let's call it the problem-in-a-box framework. The goal of this framework is to take a messy, frightening corporate problem and see if you can fit it neatly inside a box, defining its edges and understanding its dimensions. If the problem fits in the box, it's likely a one-foot hurdle. If it's a sprawling, amorphous monster with tentacles reaching into every part of the business, it's a 7-foot hurdle you must avoid. Here is the step-by-step process. Step 1. Define the problem with ruthless precision. You must be able to write down the exact nature of the problem on a single sheet of paper, using simple language. If you cannot explain the problem to a reasonably intelligent person in 2 minutes, you do not understand it well enough. In the Amex case, the problem was the warehousing subsidiary issued fraudulent receipts, creating a massive but finite legal liability. Notice the key words. Subsidiary signifies it's not the core business, and finite signifies it can be quantified. If your problem statement sounds something like, their whole industry is being disrupted by new technology and their brand is losing relevance with younger consumers, you don't have a problem in a box. You have a systemic existential crisis that's a 7-foot hurdle. Step 2. Isolate the blast radius. You need to determine if the problem is contained or if it's contagious. Does the problem in one division infect the healthy divisions? Ask yourself, will this issue directly and permanently impair the company's primary source of revenue or its main competitive advantage? For American Express, the salad oil scandal had a massive financial blast radius, but it did not contaminate their core competitive advantage, which was the trust and utility of their cards and travelers' checks. Buffett's fieldwork confirmed this. A great modern example is a data breach at a social media company. The immediate problem is regulatory fines and bad press. But the real question is, does this cause a mass exodus of users from the platform? If the user base remains stable, the core asset, the network effect, is intact. The problem, while costly, is contained. Step 3. Assess the solution's complexity. Is the solution within the company's control? A 1-foot hurdle has a clear, albeit sometimes painful, path to resolution. For Amex, the solution was to hire lawyers, negotiate settlements, pay the claims, and shut down the offending division. It was a matter of execution and financial resources. Contrast this with a company trying to innovate its way out of obsolescence. That solution is not a clear path, it's a prayer. It depends on invention, luck, and shifting consumer tastes. Avoid problems that require a miracle to solve. Look for problems that require a checkbook and competent management to solve. Step 4. Determine the problem's shelf life. Is the problem temporary or terminal? All businesses face headwinds, but the 1-foot hurdle is a gale, not a permanent change in the climate. A recession is a temporary headwind for a strong cyclical company. A product recall is a temporary problem for a company with a strong brand and a diversified product line. The invention of the automobile was a terminal event for the horse and buggy industry. Your job is to distinguish between a corporate head cold and corporate cancer. Ask, in 5 years, will the market still be obsessing over this issue, or will it be a historical footnote in the company's annual report? The salad oil scandal is now a fascinating case study, not a lingering threat to American Express's business. That is the hallmark of a temporary problem. By applying this 4-step framework, define, isolate, assess, and determine, you build the box. You take the chaotic fear in the market and you impose order upon it. This deliberate, rational process is the perfect antidote to the emotional, narrative-driven decision-making that plagues the average retail investor. It's a key part of any serious financial education, teaching you not just how to invest, but how to think. It forces you to move beyond the scary headlines and analyze the underlying mechanics of the business and the problem it faces. This is how you develop the conviction to make a move like Buffett did, allocating significant capital when others are paralyzed by an undefined, amorphous fear. You aren't being a cowboy. You are being a disciplined analyst who has put the problem in a box and found that it's much smaller and more manageable than it appears from a distance. To truly appreciate the wisdom of seeking simple problems, we must fully examine the alternative path, the one trodden by the 99% of investors. This is the path of chasing complexity, of falling in love with the intricate and the difficult. The average investor is often repelled by the simplicity of the one-foot hurdle. It feels too easy, too obvious. There's a pervasive belief in the market that the greatest rewards must be hidden behind the greatest complexity. This leads them down a rabbit hole of esoteric financial instruments, incomprehensible business models, and most dangerously, the seductive allure of the grand turnaround story. Why does this happen? It's because complexity feels sophisticated. An investor who tells you they bought a solid blue-chip company during a temporary panic over earnings might sound prudent, but not necessarily brilliant. But an investor who tells you they've bought a deeply troubled, near-bankrupt company because they see a hidden path to recovery involving 5 different restructuring initiatives and a new, unproven technology, that person sounds smart. They sound like they have an edge. The market is filled with people who would rather lose money trying to solve a complex puzzle than make money with a simple, straightforward idea, because solving the puzzle strokes the ego. They chase the intellectual thrill of the challenge over the practical goal of a financial return. This manifests in a fascination with companies that are cheap for very, very good reasons. They see a stock trading for $2 and dream of it returning to its former glory of $50, without ever fully grappling with the systemic rot that caused the 96% decline in the first place. They read dense, jargon-filled analyst reports detailing labyrinthine plans to revitalize a dying brand or pivot an obsolete business model. They get seduced by the story, by the language of transformation and rebirth, and they mistake a well-written recovery plan for a likely recovery. This is the antithesis of the Buffett approach. Buffett is not looking for a puzzle to solve. He is looking for a race to win, and he has concluded that the easiest way to win is to enter a one-lap race against tired, one-legged competitors. The path of the 99% is to actively seek out the corporate decathlon against a field of Olympic athletes. They ignore the simple, profitable, and understandable business facing a public relations issue, and instead pour their capital into a complex manufacturing company with union problems, foreign currency exposure, massive pension liabilities, and a core product that is being made obsolete by a competitor. They do this because the complexity makes them feel engaged and intelligent. But it is this very complexity that ensures their failure. The world is an uncertain place. A successful investment requires that many things go right. When you buy a great business with a simple problem, you are minimizing the number of variables that need to go your way. You primarily need the temporary problem to be resolved. When you buy a deeply troubled business, you are making a bet that requires dozens of disparate variables to align perfectly. The management must be brilliant, the competition must stumble, the economy must cooperate, the new products must be hits, the cost-cutting must work without gutting the company. It is a bet on a perfect storm of positive outcomes, and that is simply not a high-probability way to engage in capital allocation. The 99% are playing a low-probability game because the intellectual vanity of solving a complex problem is more appealing to them than the simple, almost boring act of buying a wonderful business at a fair price and letting it compound. It is a critical error, a fundamental misunderstanding of where the real edge in investing lies. The edge is not in being smart enough to solve the unsolvable. The edge is in being wise enough to avoid it altogether. The financial consequences of choosing the right kind of problem are not subtle. They are monumental and they manifest directly on a company's financial statements and in your portfolio's returns. The one-foot hurdle strategy is, at its core, a mechanism for creating a massive margin of safety, the bedrock principle of all value investing. Let's quantify this using the American Express example. Before the scandal, Amex was trading at a price that reflected its status as a great business. Let's say it was valued at 20 times its annual earnings. The market perceived it as a safe, reliable compounder. When the scandal hit and the stock price was cut in half, the earnings power of the core business hadn't changed. Suddenly, you could buy this same incredible business for just 10 times its annual earnings. Your purchase price itself became a massive shock absorber. This is the margin of safety multiplier in action. By buying during a period of maximum pessimism, you are not only getting the future growth of the business, you are also getting the potential for a massive one-time return as the market's perception returns to normal. Your potential return is twofold: the organic growth of the business, plus the repricing of the stock from a troubled valuation to a quality valuation. This can turn a solid 10% annual return into a 50 or 100% return in the first few years. The financial impact is explosive. Now let's look at the balance sheet. A great company facing a temporary problem like Amex had a fortress balance sheet going into the crisis. It had the financial strength to absorb the $175 million hit. It could write the check, take the pain, and move on without fatally impairing its operations. The problem created a one-time dent in the balance sheet, but the underlying cash-generating engine of the business remained intact and quickly began to repair the damage. This is a crucial element of a one-foot hurdle. The company must have a financial constitution to easily step over it. The direct financial connection for a 7-foot hurdle is the exact opposite. It is a slow, relentless drain on the balance sheet. A company in a declining industry with broken operations doesn't have a one-time problem. It has a perpetual crisis. Its balance sheet is constantly under assault. It needs constant capital expenditures just to stay in the game. It's often burdened with huge amounts of debt that suffocate any potential profit, and it generates little to no free cash flow. This is what Buffett discovered with Berkshire Hathaway's original textile mills. The business was a money pit. Every year, any small profit it made had to be reinvested into new machinery just to remain competitive with lower-cost rivals. It was a capital-intensive treadmill to nowhere. Investing in such a business is like pouring water into a bucket full of holes. The balance sheet itself becomes a destroyer of capital. The opportunity cost is staggering. Every dollar trapped in that struggling enterprise is a dollar that could have been invested in a wonderful business that gushes cash instead of consuming it. The financial difference is the difference between rolling a snowball up a hill versus rolling it down a long, snowy mountain. One consumes energy and gets you nowhere. The other harnesses a powerful natural force to build upon itself. The one-foot hurdle strategy is a disciplined search for those snowy mountains that are, for a brief moment, available at the price of a small hill. This leads us to the dark side of this philosophy, the alluring and treacherous world of the 7-foot hurdle. To master Buffett's strategy, you must develop an almost allergic reaction to the types of investments that trap and destroy the capital of most investors. It's not enough to know what to look for, you must be even better at knowing what to avoid. The 7-foot hurdle is the complex turnaround, the deep value trap, the cigar butt that promises one last free puff but is often filled with something far more toxic. And ironically, the greatest foundational anecdote for understanding this mistake comes from the master himself. It is the story of his purchase of Berkshire Hathaway. Yes, the company that is now a $500 billion behemoth was, in Warren Buffett's own words, his single greatest investment mistake. In the early 1960s, before he was a quality investor, Buffett was a disciple of his mentor, Benjamin Graham. He practiced what he called cigar butt investing, looking for companies that were trading for less than their net working capital. The idea was that you could find a terrible business that was so cheap it was like finding a discarded cigar on the street with one free puff left in it. You pick it up, take the puff and throw it away. It's a purely quantitative strategy, and it can work, but it is grueling, and it locks you into dealing with terrible businesses. In 1962, Buffett started buying shares of Berkshire Hathaway, a struggling New England textile manufacturer. The business was in a dying industry. Foreign competition was brutal. The company was constantly closing mills and laying off workers. But the stock was cheap. It was a classic cigar butt. Buffett's plan was to profit from the company's liquidations. As they closed mills, they would distribute the cash, and he would make a small, predictable profit. The CEO at the time, a man named Seabury Stanton, made a tender offer to buy back shares at a specific price. Buffett agreed to tender his shares, but when the formal offer came out, Stanton had lowered the price by a tiny fraction. It was a small act of bad faith, but it infuriated the young Warren Buffett. In a fit of pique, instead of selling, he did the opposite. He started aggressively buying up shares until he had a controlling interest, and then he fired Seabury Stanton. Now Buffett was the proud owner of a dying textile business. He had cleared the hurdle of management, but he was now faced with a 7-foot wall, the irreversible decline of the entire American textile industry. He spent the next 20 years battling this reality. He poured the profits from his other brilliant investments back into the textile business, trying to keep it afloat. He bought new equipment. He fought for efficiency. He was the heroic manager trying to engineer a turnaround. But it was a battle against an unstoppable economic tide. As he later admitted, all that effort and all that capital produced abysmal returns. The textile business was a black hole for money. He called it a, quote, monumental mistake. The money he funneled into the failing textile operations could have been invested in wonderful businesses, where it would have compounded at a much higher rate. He eventually had the good sense to use Berkshire Hathaway as a holding company to buy other, better businesses, like insurance companies and See's Candies. But the original sin of buying the textile mill cost him and his investors billions in opportunity cost. This story is the perfect illustration of a 7-foot hurdle. It had multiple, interlocking problems. First, it was in a fundamentally broken industry. No amount of managerial genius can save a bad business in a terrible industry. Second, it was intensely competitive, with no durable advantage. Third, it was capital-intensive, requiring constant reinvestment just to tread water. Buffett, the hero investor, tried to leap this hurdle. And while he didn't crash and burn, he was smart enough to pivot. The endeavor itself was a colossal waste of time, energy, and, most importantly, capital. It taught him the lesson that would define the rest of his career. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The psychological pull of the 7-foot hurdle is immensely powerful, and it's rooted in some of the most potent cognitive biases that affect human decision-making. The primary culprit is overconfidence bias, often coupled with a touch of the Dunning-Kruger effect. Overconfidence bias is the tendency for people to be more confident in their own abilities, in this case, their analytical or managerial skills, than is objectively reasonable. When an investor looks at a broken company, like the old Berkshire Hathaway textile mill, they don't just see the problems, they see themselves as the solution. The narrative they tell themselves is not, "This is a failing business," but rather, "This is a failing business that them smart enough to understand and whose turnaround am smart enough to predict." This is the hero complex we discussed earlier. It's the belief that your individual insight is so profound that you can see the one hidden path to success that everyone else has missed. The Dunning-Kruger effect is a related bias where people with low ability at a task overestimate their ability. In the complex world of corporate strategy and turnarounds, most retail investors are, frankly, amateurs. But they may not know what they don't know. They read a few articles, look at a simplified financial summary, and believe they have a grasp on the monumental challenges of shifting a company's entire culture, product line, and market position. They overestimate their competence and therefore underestimate the difficulty of the task. They see a 7-foot hurdle and, because of their overconfidence, perceive it to be only 3 or 4 feet high. This is what leads people to buy stocks in companies like Sears or Blockbuster long after the writing is on the wall. They hear a new CEO's turnaround plan and think, "This is it. This is the plan that will work. They are seduced by the story of resurrection because it allows them to feel like a shrewd contrarian genius who saw the comeback before anyone else. They are not making a cold, calculated bet. They are making an emotional investment in a narrative where they play a starring role as the brilliant visionary. Buffett's later philosophy is a direct antidote to this bias. The search for one-foot hurdles is an act of profound intellectual humility. It is an admission that you are probably not a business genius capable of reviving a dying enterprise. It is a recognition that turning around a troubled company is one of the hardest things to do in business, and that the probability of success is dismally low. By focusing on simple problems at great companies, you are removing your own ego from the equation. The investment thesis is not, "I am smart enough to fix this." The thesis is, "This business is so good, it will fix itself once this temporary problem passes." This shift from intellectual hubris to intellectual humility is the psychological leap that every successful long-term investor must make. It's the difference between trying to be a hero and trying to make money. The market is a graveyard of would-be heroes who tried to leap 7-foot hurdles. The fortunes are made by those who patiently wait for the 1-foot hurdles to appear in the paths of champions. To operationalize this sense of intellectual humility and avoid the siren song of the turnaround, we need a practical mental model. We need a systematic way to diagnose a 7-foot hurdle before it ever enters our portfolio. Let's call this blueprint the turnaround autopsy technique. The idea is to study the failures of the past to develop a robust checklist of red flags for the future. Instead of trying to predict the next successful turnaround, your goal is to become an expert at identifying the characteristics of the ones that were doomed from the start. Here is how you perform a turnaround autopsy. Step 1. Select a recent, high-profile corporate failure. Think of companies like Sears, JCPenney, Bed Bath & Beyond, or even General Electric in its decline. These are your case studies. Step 2. Create a red flag checklist and analyze your case study against it. Your checklist should include the following warning signs. First red flag. Is the company facing a single acute problem or multiple chronic illnesses? Sears wasn't just losing to Amazon. It had a crumbling store base, a tarnished brand, massive debt, a crippling pension liability, and a history of poor management. This is the difference between a broken leg and multi-organ failure. One is survivable, the other is not. Multiple interlocking problems are a giant red flag. Second red flag. Is the industry in a secular decline? A great jockey on a dying horse will not win the race. Blockbuster had a terminal problem. Its entire business model was being rendered obsolete by technology. First Netflix's DVDs by mail, then streaming. No amount of operational improvement could have saved that business. You must distinguish between a cyclical downturn, which ends, and a secular decline, which is permanent. Avoiding dying industries is one of the easiest ways to avoid 7-foot hurdles. Third red flag. Is the balance sheet a boat anchor? Look at the debt levels. A company with a mountain of debt has no room to maneuver. Every dollar of cash flow goes to servicing debt, not to investing in the business or returning capital to shareholders. High debt turns a difficult situation into an impossible one. It's the financial equivalent of trying to run a marathon with a weighted vest on. Fourth red flag. Is there a revolving door in the C-suite? How many CEOs has the company had in the last 5 years? Constant leadership turnover is a sign of deep, unresolved strategic problems. It means the board has no clear vision, and each new leader's plan is abandoned before it has a chance to work. It signals chaos, not a coherent turnaround. Fifth red flag. Is the solution based on hope or execution? Does the turnaround plan rely on inventing a new hit product, predicting a change in consumer taste, or some other factor outside of management's direct control? Or is it based on tangible, executable steps like cost-cutting, selling non-core assets, and paying down debt? Plans based on hope are lottery tickets. Plans based on execution are strategies. By consistently running these autopsies on failed companies, you will train your brain to recognize the patterns of failure. You will develop an intuitive feel for the difference between a solvable problem and a death spiral. This technique, a core part of a sound financial education, shifts your focus from wishful thinking to a disciplined analysis of risk. You become less of a treasure hunter looking for a diamond in a landfill and more of a bomb disposal expert, carefully identifying and avoiding the investments that are most likely to blow up your portfolio. This is the essence of advanced risk management. The most effective way of avoiding losses is to never put yourself in a position where you are counting on a miracle. The path of the 99% when it comes to turnarounds is paved with good intentions and bad outcomes. It is driven by one of the most powerful and destructive emotions in investing: the ego-driven desire to be the hero. The average investor who gets involved in a deep, complex turnaround story is rarely doing it from a place of cold, sober analysis. They are participating in a drama, and they have cast themselves in a leading role. This hero-investor complex is the antithesis of the Buffett model, and it explains why so many people are drawn to these low-probability bets. The story is intoxicating. You find a company that has been beaten down, abandoned by Wall Street, and left for dead. You, the clever, independent thinker, see something that nobody else does. You buy the stock for pennies on the dollar. You weather the storms of doubt and criticism. And then, through a combination of your brilliant foresight and the heroic efforts of a new CEO, the company rises from the ashes. The stock soars, you are vindicated, and you get the twin rewards of being both rich and proven right. This narrative is as compelling as any Hollywood script, and it is a fantasy that has lured countless investors to their financial doom. The problem is that investing is not a movie. The desire to be right in a dramatic, contrarian way often overpowers the more mundane desire to simply make money. An investment in a solid, high-quality company that grinds out a 12% annual return for decades doesn't make for a great story at a cocktail party. But a wild bet on a bankrupt airline that triples in a week before collapsing back to zero does. The hero investor is chasing the story, not the return. This complex also leads to a dangerous form of confirmation bias. Once an investor has bought into the turnaround narrative, they will actively seek out information that confirms their heroic thesis and ignore the mountains of evidence that contradict it. They will cling to every small piece of positive news, a slightly better than expected sales number, a positive comment from an analyst as proof that the turnaround is working. They will dismiss overwhelmingly negative signs like continued market share loss or mounting debt as mere short-term noise. Their emotional investment in being right prevents them from making an objective assessment of the facts. They are no longer an investor, they are a fan, cheering for their team, blind to the fact that their team is losing by 50 points in the fourth quarter. The simple, humble approach of buying great companies with small problems has none of this dramatic flair. It is a quiet, patient, and often boring process. It is a strategy for builders, not for heroes. It doesn't offer the same ego gratification, but it offers a much higher probability of success. The 99% are playing a game of narrative and emotion. The one-foot hurdle investor is playing a game of business analysis and probabilities. And over the long run, the probabilities always win. The hero investor gets a few good stories to tell. The patient, disciplined investor gets the financial freedom that makes the stories unnecessary. The direct financial connection between a 7-foot hurdle and your portfolio is a concept called capital destruction. It's not just that these investments fail to produce returns. They actively consume and annihilate the capital you put into them, creating a permanent drag on your wealth-building journey. Let's trace the flow of money to see how this works. When you invest in a struggling turnaround, you are often buying into a business with negative free cash flow. This means that after all the expenses and necessary reinvestments are paid, the business is losing money. Where does that money come from? It comes from one of three places. It's either drawn from the company's existing cash reserves, it's raised by issuing new shares, diluting your ownership, or it's borrowed, adding to the debt burden. In all three cases, shareholder value is being destroyed. the balance sheet becomes a financial drainpipe. Think of a company like the old Berkshire textile mill. Let's say it generates $100 million in revenue, but has $105 million in costs and necessary capital expenditures. That $5 million annual loss has to be funded. Buffett had to take $5 million from his other profitable businesses and inject it into the mill just to keep the doors open. That $5 million is gone forever. It didn't earn a return. It was incinerated in the furnace of a bad business. This is a direct attack on your capital. Furthermore, the opportunity cost is a silent killer of wealth. That $5 million that Buffett poured into the textile mill could have been used to buy more of a company like See's Candies or the Washington Post, businesses that gushed cash instead of consuming it. Compounded over 20 years, that $5 million, if invested in a great business, could have become $50 or $100 million. By keeping it tied up in the turnaround, the final cost wasn't just the $5 million that was lost, it was the $95 million in potential gains that were never realized. This is why Buffett calls these businesses, quote, quicksand for capital. The more you struggle, the deeper you sink. The financial statements of a 7-foot hurdle tell a story of erosion. You see shareholder equity declining year after year. You see debt levels rising. You see the share count increasing as the company desperately sells off pieces of itself to stay alive. Each of these trends is a direct financial transfer of value away from you, the common shareholder. The promise of a turnaround is that this trend will heroically reverse. The reality, in the vast majority of cases, is that this slow, grinding destruction of capital continues until there is nothing left. A 1-foot hurdle investment is the polar opposite. You are buying into a business that, despite its temporary problem, still has positive cash flow and a strong balance sheet. The business itself is a capital-generating machine. Your investment is not being used to plug leaks. It is being added to a growing pile of wealth that the company can then use to reinvest in growth, buy back shares, or pay dividends. All activities that increase rather than destroy shareholder value. The financial difference is stark. One is a compounding machine, the other is a shredding machine. The single most important decision in your investment strategy is choosing which machine to put your money into. Before you can ever identify a great company that has stumbled, you must first be able to identify a great company in the first place. The 1-foot hurdle is the opportunity, but the great business is the entire foundation upon which the strategy is built. Ignoring this is like focusing on the discount of a product without checking if the product itself is any good. This brings us to a pivotal moment in Warren Buffett's own evolution as an investor, a moment that shifted him permanently from the quantitative world of cigar butts to the qualitative world of quality investing. This is the story of See's Candies, and it is the foundational anecdote for understanding how to identify a fortress-like business before you even start looking for problems. By the early 1970s, Buffett had already experienced the pain of the Berkshire Hathaway textile mill, the 7-foot hurdle. He was beginning to understand the immense burden of a bad business. At the 1972 Berkshire Hathaway annual meeting, his longtime partner, Charlie Munger, pitched him an idea: the acquisition of a California-based chocolate company called See's Candies. On the surface, it looked like a terrible deal by Buffett's old standards. The company was being offered for $25 million. At the time, its tangible assets, the factories, the inventory, the stores, were only worth about $8 million. This meant Buffett would have to pay a $17 million premium for something he couldn't see or touch: the brand, the customer loyalty, the reputation. This was goodwill, an intangible asset that his mentor, Ben Graham, had taught him to be deeply suspicious of. The old Buffett, the cigar butt investor, would have rejected the deal instantly. It was the opposite of buying a company for less than its liquidation value. But Charlie Munger pushed him. He argued that See's Candies possessed a powerful, though invisible, competitive advantage. It had a brand that was beloved by its customers. For decades, Californians had been giving See's chocolates as gifts for birthdays, holidays, and anniversaries. The act of giving a box of C's was associated with love and affection. This gave the company tremendous pricing power. The cost of a box of chocolates was a small part of the emotional transaction. A customer wouldn't risk disappointing a loved one to save $1 or $2 by buying a generic brand. They would happily pay a little more each year for the trusted, high-quality product they knew. This meant C's could raise its prices year after year to cover inflation and then some, without losing customers. It was, in Munger's words, a business with a deep and durable moat around it. Buffett, still skeptical, did his due diligence. He saw a business with remarkably consistent earnings, high returns on capital, and very little need for reinvestment. The company essentially minted cash. He overcame his old biases and, alongside Munger, agreed to buy See's Candies for $25 million. It was a transformative decision. Over the subsequent decades, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It was a gusher of cash that Buffett could then use to buy other wonderful businesses. See's taught Buffett and Munger the true economic value of a high-quality, intangible asset like a brand. It showed them that a business with a protective moat could be a far better long-term investment than a statistically cheap, mediocre business, even if it required paying a higher initial price. The lesson was profound. The search for investment opportunities should not start with a stock screener looking for low prices. It should start with a qualitative analysis, looking for great businesses. Once you have identified a company with the economic characteristics of a See's Candies, a durable competitive advantage, pricing power, high returns on capital, and low capital needs, then, and only then, do you wait patiently for the market to offer you a one-foot hurdle, a temporary problem that allows you to buy that wonderful business at a sensible price. The See's Candies acquisition was the intellectual cornerstone of the modern Berkshire Hathaway. It was the moment Buffett fully transitioned from buying fair companies at wonderful prices to buying wonderful companies at fair prices, and it provides us with the blueprint for the most crucial step in this entire investment strategy: identifying quality before the stumble. The human mind's tendency to create and believe in halos is a powerful psychological force that can both help and hinder an investor. The halo effect is a cognitive bias where our overall impression of a person, brand, or company in one area influences our feelings and thoughts about their character or properties in other areas. Once a company is labeled as great, like an Apple or a Coca-Cola, we tend to view all of its actions, products, and financial results through a positive, glowing lens. We give it the benefit of the doubt. This is the psychological principle that underpins the power of a great brand, the very thing Buffett and Munger identified in See's Candies. For See's, the halo was their reputation for quality and tradition. This halo allowed them to command premium prices and engender fierce customer loyalty. When you are analyzing a business for quality, you are in essence trying to identify the source and durability of its halo. However, this same psychological principle can be a trap for investors. We can become so enamored with a company's halo that we fail to see when the underlying business is starting to tarnish. This is where another bias, survivorship bias, comes into play. We study the great companies that have survived and thrived for decades, the survivors, and we often underestimate how many other companies that once seemed equally great have fallen by the wayside. For every Coca-Cola, there are dozens of other beverage companies that once had strong regional brands but are now distant memories. We see the winners and construct narratives about their eternal moats, forgetting the graveyard of businesses whose moats proved to be shallow and easily crossed. A successful investor in quality must therefore perform a difficult mental balancing act. You must be able to appreciate the immense power of a positive halo effect, while simultaneously fighting against its ability to cloud your judgment. You need the skepticism to constantly question whether the moat is as deep as it appears. Buffett's approach is not to simply buy companies with great reputations. His approach is to understand the specific economic engine that creates and sustains that reputation. He is not interested in the halo itself. He is interested in the light bulb that generates it. For See's Candies, the light bulb was not just a good brand. It was the specific combination of a culturally ingrained gift-giving tradition, the low price point of the product relative to the emotional value, and the resulting pricing power that this created. This is a much deeper level of analysis than simply saying people love See's. It's about deconstructing why they love it and whether that reason is likely to endure for decades. To be a successful quality investor, you must become an analyst of human behavior and competitive dynamics, not just a collector of well-known brand names. You must ask the tough questions. Why does this company have pricing power? What prevents a competitor from offering a similar product for less? How high are the switching costs for a customer to leave? Is the company's advantage based on a temporary technological lead or a deep, structural feature of its industry? By focusing on the underlying mechanics of the business rather than just its popular reputation, you can avoid the twin traps of the halo effect and survivorship bias. You begin to see businesses not as static entities labeled good or bad, but as dynamic systems with strengths and vulnerabilities. This allows you to identify the truly resilient businesses, the ones whose quality is not just a story but an objective, structural reality. To translate this thinking into a practical skill, we need a repeatable process for discovering and verifying the existence of a durable competitive advantage, or a moat. Let's call this blueprint the moat mapping process. This is a framework for any retail investor or entrepreneur to move beyond surface-level analysis and truly understand a company's strategic position. Step 1. Identify the potential moat type. Most durable competitive advantages fall into one of 5 categories, as popularized by investment research firm Morningstar. You must first form a hypothesis about which, if any, of these a company possesses. The 5 types are network effects, where a service becomes more valuable as more people use it, like Facebook or the Visa payment network. Intangible assets, which include brands like Coca-Cola, patents like those held by a pharmaceutical company, or regulatory licenses that are difficult to obtain. Cost advantages, where a company can produce a product or service at a much lower cost than competitors, like Walmart's supply chain or Geico's direct-to-consumer model. Switching costs, where it is too expensive, time-consuming, or risky for a customer to change to a rival provider, such as the software your entire company is trained on or the bank that holds your mortgage and all your accounts. And finally, efficient scale, where a market is effectively served by one or a very small number of companies, making it uneconomical for a new competitor to enter, like a railroad or a pipeline serving a specific region. Your first task is to look at a business and ask, if a moat exists here, what kind is it? Step 2. Find the evidence and quantify the advantage. A hypothesis is not enough. You need to find proof in the financial statements and the company's operating history. For a brand's pricing power and intangible asset, look for consistently high gross margins compared to competitors. This shows they can charge more without it costing them more to produce. For switching costs, look for very low customer churn rates or revenue retention figures. For a network effect, look for evidence of a winner-take-all dynamic in their market share. For a cost advantage, look for operating margins that are sustainably higher than the industry average. You are looking for the financial fingerprint of the moat. This step turns a qualitative story into a quantitative reality. Step 3. Stress test the moat's durability. Moats can and do fade. You must play devil's advocate and think like a competitor. Ask the hard questions. What could disrupt this advantage? For a brand, could a shift in consumer values make it seem old-fashioned? For a patent, when does it expire and is the R&D pipeline strong enough to replace it? For a network effect, could a new technology create a competing network that is even better? For a cost advantage, could a foreign competitor with cheaper labor emerge? This is the most important step. You must actively try to destroy your own investment thesis. If you can't find a compelling argument for how the moat could be breached in the next 10 years, you may have found a truly durable one. By following this moat mapping process, you develop a deep, nuanced understanding of a business. You move beyond simply recognizing a famous name and start to think like a long-term business owner. This is the essential groundwork. This financial education in identifying quality is what gives you the confidence to act decisively when a one-foot hurdle appears. Because when a company with a deep, well-understood moat stumbles, you know you are not just buying a cheap stock. You are acquiring a piece of an extraordinary business at a rare moment of opportunity. The antithesis to this disciplined search for quality is the path of the 99%, which is to focus almost exclusively on price while paying lip service to the concept of value. The average retail investor, often armed with a brokerage account and a stock screening tool, engages in a process that is the complete reverse of the moat mapping framework. Their journey begins not with the question, "What is a wonderful business?" but with the question, "What is a cheap stock?" They will run a screen for stocks with low price-to-earnings ratios, low price-to-book ratios, or stocks that have recently fallen the most in price. They generate a list of statistically cheap securities, and then they begin the process of trying to justify why one of these might be a good investment. This price-first approach is one of the most common and most destructive mistakes in investing. It inevitably leads you to a portfolio filled with mediocre, troubled, and structurally disadvantaged businesses. The stocks on the 52-week low list are usually there for a reason. The companies with the lowest PE ratios often have them because the market has correctly identified that their earnings are unsustainable and likely to decline. By starting with price, you are fishing in a pond that is disproportionately stocked with sick and dying fish. You might occasionally find a healthy one that was thrown in by mistake, but you will spend most of your time sorting through junk. This behavior is rooted in a fundamental misunderstanding of what a stock is. The 99% often treat stocks as if they are abstract lottery tickets, blips on a screen that go up or down. They detach the price of the stock from the reality of the underlying business. The Buffett and Munger approach, refined by the See's Candies purchase, is to always remember that you are buying a piece of an actual business. Therefore, the first and most important question must be, is this a business I would be happy to own in its entirety for the next 10 years? If the answer is no, the price is irrelevant. A bad business does not become a good investment just because its stock price is low. In fact, a falling price for a bad business is often just a prelude to a lower price. This is the essence of a value trap. It looks cheap, it feels cheap, but it continues to get cheaper because the underlying business is deteriorating. The investor who bought it based on a low PE ratio watches in horror as the earnings, collapses, making the PE ratio suddenly look expensive. Focusing on price over value also makes investors impatient. They buy a cheap stock and expect it to quickly revert to the mean. When it doesn't, they get frustrated and sell, often for a loss, to chase the next statistically cheap idea. The quality-first investor, on the other hand, is a patient owner. They have bought a piece of a wonderful business. They are happy to wait for the one-foot hurdle to be cleared because they know that every day they own the stock, they are owning a business that is growing stronger, deepening its moat, and increasing its intrinsic value. The price-first investor is a speculator in stock prices. The quality-first investor is a partner in a wealth creation machine. This simple inversion of process, starting with business quality instead of stock price, is a radical departure from the norm, and it is the key to avoiding the value traps that ensnare the vast majority of market participants. The direct financial connection between owning a high-quality business and your portfolio's performance can be summed up in one of the most important metrics in all of finance: return on invested capital, or ROIC. While that may sound technical, the concept is simple and profoundly important. ROIC measures how much profit a company generates for every dollar of capital that is invested in the business. It is the financial fingerprint of a company with a great moat. A company with a high and sustainable ROIC is a compounding machine. Imagine two businesses. Business A takes $100 of capital and at the end of the year generates $10 in profit. It has an ROIC of 10%. Business B takes $100 of capital and generates $20 in profit. It has an ROIC of 20%. Business B is a far superior business. It is twice as efficient at turning capital into profit. A company like C's Candies had a phenomenal ROIC. Because the brand was so powerful, it didn't need to build a lot of new factories or spend massively on advertising to grow. It could raise prices each year, and the profits would pour in without requiring much new investment. This is the financial expression of a moat. A company with a deep moat can fend off competition and maintain high returns on its capital for decades. A company in a brutally competitive industry with no advantage, like the old Berkshire textile mill, has to constantly spend money on new machines and price cuts just to survive. Its ROIC will be chronically low. When you buy a piece of a high ROIC business, you are harnessing a powerful tailwind. The company is so profitable and efficient that it can fund its own growth and still have tons of cash left over to return to shareholders through dividends or buybacks. The intrinsic value of the business is compounding internally at a high rate, regardless of what the stock price is doing on any given day. Over the long run, a stock's return will closely follow the underlying business's return on invested capital. This is an iron law of finance. If you own a collection of businesses that are consistently earning 20% on their capital, it is highly likely that your long-term investment returns will also approach 20%. If you own a portfolio of mediocre businesses earning just 6% on their capital, your returns will be mediocre as well. The moat mapping process is really a qualitative search for the sources of high ROIC. And the search for a one-foot hurdle is the search for an opportunity to buy one of these high ROIC machines at a moment when the market is temporarily distracted and has marked it down to a price that implies a much lower, more mediocre return. This is the holy grail of this entire investment strategy: buying a 20% return business at a 10% return price. The financial impact is a powerful double whammy. You benefit from the high rate at which the business compounds its own value, and you get the added kicker of the market eventually re-rating your stock to a higher multiple once the temporary fear subsides. That is the quantifiable balance sheet-driven formula for beating the market over the long term. Even after you've mastered the art of identifying a great business and have found one facing a one-foot hurdle, the most difficult part of the process is yet to come: the execution. This is the moment of maximum fear, of maximum uncertainty, when you must pull the trigger and make your investment while the rest of the world is screaming, "Sell!" This requires a specific and rare psychological temperament, a deep well of patience and conviction. And there is no better foundational anecdote to illustrate this than Warren Buffett's investment in Wells Fargo during the banking panic of the early 1990s. In 1990, the mood in America was grim. The economy was tipping into a recession, and there was a widespread panic about the health of the U.S. banking system, particularly in California, where a commercial real estate bubble had burst in spectacular fashion. Banks that had lent aggressively against inflated property values were now facing a tidal wave of defaults. The headlines were filled with stories of bank failures and government bailouts. The consensus on Wall Street was to avoid bank stocks at all costs. They were seen as black boxes filled with toxic loans. Wells Fargo, a major player in the California market, was hit especially hard. Its stock price plummeted, falling by nearly 50%. The fear was that its loan losses would be so catastrophic as to wipe out the bank's equity. The market was pricing it for disaster. This was the moment of peak pessimism. But Warren Buffett, sitting in Omaha, saw things differently. He had long admired Wells Fargo. He knew its CEO, Carl Reichert, was a brilliant, no-nonsense manager and a superb capital allocator. He knew Wells Fargo had a history of being a more disciplined lender than its peers, and had a low-cost operating structure that made it highly profitable in normal times. He saw a great business run by great management that was now caught in a storm of industry-wide fear. He saw the one-foot hurdle. The hurdle was the California real estate crisis. The question was whether Wells Fargo was strong enough to step over it. Buffett began his analysis. He didn't have a crystal ball to predict the exact bottom of the real estate market. Instead, he focused on the bank's long-term earning power. He analyzed their loan book and concluded that while the losses would be significant, they were manageable. He calculated that even under a severe stress scenario, the bank's underlying profitability was so strong that it could earn its way out of the problem in a few years. The market was focused on the short-term pain. Buffett was focused on the long-term gain. He concluded that buying Wells Fargo at the panic-induced prices of 1990 was like buying a dollar for 50 cents, with the caveat that you had to have the stomach to watch that dollar potentially trade for 40 cents in the short term. So he acted with conviction. Berkshire Hathaway began accumulating a massive position, ultimately investing nearly $300 million to acquire 10% of the company. It was a deeply contrarian bet. He was buying when the experts were selling, when the news was terrible, and when the future looked bleak. He was acting on his analysis, not on the market's emotions. And what happened next was a textbook case of a one-foot hurdle being cleared. The real estate market in California eventually bottomed out and began to recover. Wells Fargo, having survived the storm, saw its profits rebound dramatically. The market's fear subsided and was replaced by a renewed appreciation for the bank's quality. The stock price soared. Over the next decade, Buffett's initial investment in Wells Fargo would increase more than tenfold, becoming one of his most successful investments ever. The story is a masterclass in execution. It demonstrates that identifying the opportunity is only half the battle. The other half is having the psychological fortitude, the temperament, to act on your conviction in the face of overwhelming opposition and fear. It is the ability to be greedy when others are fearful, not as a catchy slogan, but as a practiced, disciplined investment strategy. The emotional storm that surrounded Wells Fargo in 1990 is a perfect laboratory for studying the two cognitive biases that cause most investors to fail: loss aversion and herd behavior. Mastering these is the key to developing the temperament required for successful execution. Loss aversion is a principle, first identified by psychologists Daniel Kahneman and Amos Tversky, which shows that for most people, the psychological pain of losing a certain amount of money is roughly twice as powerful as the pleasure of gaining the same amount. This is hardwired into our brains. A potential loss looms larger in our minds than a potential gain. When a stock like Wells Fargo was falling 50%, investors felt this pain intensely. The fear of further loss became overwhelming. Their brain's primary signal was not, "This is a great business on sale," but "Get out now to avoid more pain." This primal urge to stop the bleeding is what drives panic selling at the bottom of a market cycle. It forces people to sell their best assets at the worst possible time, locking in permanent losses. Buffett's temperament is a learned, conscious override of this instinct. He has trained himself to view price declines not as a source of pain, but as a source of opportunity. His emotional reaction to a falling stock price for a company he wants to own is not fear, but excitement. He has reframed the situation. For him, a market panic is a clearance sale on quality merchandise. This reframing is a crucial mental discipline that separates him from the crowd. The second bias is herd behavior, the tendency for individuals to mimic the actions of a larger group, regardless of their own independent information or analysis. When the entire financial news media and all the top analysts are screaming that banks are uninvestable, it takes an extraordinary amount of intellectual independence and self-confidence to step up and buy. The social pressure to conform is immense. Our brains evolved to find safety in the herd. Straying from the group was historically dangerous. In the financial markets, however, the herd is almost always wrong at major turning points. The herd buys at the top when euphoria is rampant, and sells at the bottom when pessimism is at its peak. Buffett's entire career is a testament to the profits that can be made by calmly walking in the opposite direction of the stampeding herd. He and Munger call it having an inner scorecard. Most people operate on an outer scorecard, judging their success based on whether other people agree with them. If they buy a stock and it goes up and everyone pats them on the back, they feel smart. Buffett operates on an inner scorecard. He judges his decisions based on whether they align with his own research and principles, regardless of popular opinion. His purchase of Wells Fargo was a perfect inner scorecard decision. By every external measure, it was a bad decision at the time. But on his internal scorecard, it was a great decision because it was a rational action based on a sound, long-term analysis of value. To execute this strategy, you must cultivate this inner scorecard. You must have more faith in your own homework than you do in the clamor of the crowd. This is not about being a stubborn contrarian for the sake of it. It is about having done the work to build a level of conviction that is immune to the emotional tides of the market. It's the psychological armor that allows you to execute when it matters most. Developing this kind of psychological armor isn't something that happens overnight. It requires practice and the use of practical mental tools to short-circuit our destructive emotional impulses. One of the most effective blueprints for this is what we can call the anti-timing journal. This is not a journal for predicting the market, but a tool for managing your own reactions to it. It is a simple, written exercise that you must perform whenever you feel a strong emotional urge to make a portfolio decision, whether it's the urge to panic sell during a crash or the urge to FOMO buy into a soaring stock. Here's the step-by-step process. Step 1. Acknowledge and name the emotion. When the market is crashing and you feel that pit in your stomach, take out your journal and write it down. I am feeling intense fear and the urge to sell my holdings in Company X. The simple act of naming the emotion creates a small psychological distance from it, allowing your rational brain to get a word in. Step 2. Write down the emotional case for action. Let your fearful brain have its say. Write down all the reasons you feel you must act now. The experts on TV are saying it's going to get worse. My friend just sold everything. If I don't sell now, I could lose even more money. The headlines are all terrible. Get it all out on paper. This validates the emotion without acting on it. Step 3. Force yourself to write the rational case against action. This is the most critical step. You must now switch to your analytical brain, the one that has studied Buffett and understands the one-foot hurdle strategy. Write down the reasons why selling now might be a mistake. I am selling a piece of a wonderful business that I identified using the moat mapping process. The current problem is a market-wide panic, not a fundamental issue with this specific company. The stock is now cheaper than it was last week, meaning my expected future returns are higher, not lower. Selling now would be letting the herd's fear dictate my long-term financial plan. Warren Buffett would likely be buying today, not selling. Step 4. Reread your original investment thesis. In your journal, you should have a section for every stock you own, with a simple paragraph outlining why you bought it in the first place. I bought Company X because it has a powerful network effect, consistently high returns on capital, and is run by excellent management. I purchased it at a price I believed was fair for a long-term hold. Read this thesis out loud. This reminds you that your decision to buy was made during a time of calm rationality, and your urge to sell is being driven by a moment of temporary emotionality. The anti-timing journal acts as a circuit breaker. It forces a pause between the emotional stimulus, fear, and the impulsive reaction, selling. It deliberately engages the slow, analytical part of your brain to counterbalance the fast, emotional part. By making this a mandatory process for every major portfolio decision, you train yourself to be a more disciplined, temperamentally sound investor. You create a record of your emotional state during market cycles, which you can review later to learn about your own biases. It is a simple but profoundly effective tool for moving from the reactive stance of the 99% to the proactive, prepared stance of a master capital allocator. It's how you build your inner scorecard, one journal entry at a time. The path of the 99% during a market panic is predictable, reactive, and ultimately self-destructive. It is the exact opposite of the disciplined execution model we've just described. The average investor's decisions are not driven by a premeditated investment strategy, but by the fire hose of information and emotion coming from the financial media and their social circle. Their behavior is a textbook example of reacting to headlines. When the market is calm and rising, the headlines are positive. Companies are reporting good earnings, analysts are bullish, and stories of overnight millionaires are common. This is when the average investor feels most comfortable buying. They are buying not because the prices are attractive, but because the social proof is high and the emotional environment feels safe. They are buying euphoria. Then, the inevitable downturn comes. The headlines turn dark. The very same analysts who were bullish are now predicting doom. The stories are of financial ruin and recession. This is the moment when fear takes over. The average investor who bought near the top is now seeing red in their portfolio. Their comfortable, safe environment has become a terrifying house of horrors. Their reaction is not to consult their investment thesis, they likely never had one, but to seek relief from the psychological pain. They sell. They sell not because the long-term prospects of their businesses have changed, but because the short-term headlines have. They are selling fear. This destructive cycle of buying euphoria and selling fear is the primary reason why the average investor's returns dramatically underperform the market averages over time. They are systematically buying high and selling low, all because they are outsourcing their emotional state to the news cycle. The one-foot hurdle strategy demands the complete inversion of this behavior. It requires you to use the headlines as a contrary indicator. When the financial media is at its most hysterical, when every headline is predicting the end of the world for a certain industry or company, that is your signal to start paying attention. That is the moment when a one-foot hurdle opportunity is most likely to emerge. You are using the herd's panic as your research assistant, pointing you toward areas of potential mispricing. The 99% see a terrifying headline about a bank's real estate losses and immediately think, "I need to sell my bank stocks." The disciplined investor sees the same headline and thinks, "This might be the emotional storm that allows me to buy a great bank like Wells Fargo at a price I could only dream of last year." It is a fundamental shift in perspective. The 99% are consumers of financial news, allowing it to dictate their actions. The elite investor is an analyst of financial news, using it as a gauge of market sentiment to inform their actions. They are not reacting to the news, they are reacting to the market's overreaction to the news. This is the core of beating the market. You don't outsmart the market with complex algorithms. You outbehave the market by remaining rational when it becomes emotional. The direct financial connection between temperament and returns is perhaps the most powerful force in portfolio management. It is the concept of volatility as an asset, rather than a liability. For the average investor, the 99%, market volatility is pure risk, pure liability. A stock price that swings wildly is seen as dangerous and unpredictable. When prices fall, it represents a direct loss, causing fear and prompting the destructive decision to sell at the bottom. The financial result of this perspective is that they experience all of the downside of volatility and capture very little of the upside. They are perpetually whipsawed by the market's mood swings. For the disciplined one-foot hurdle investor, this entire equation is flipped on its head. Volatility, when combined with a sound analytical framework and a fortress-like balance sheet, both in the companies you own and in your personal finances, is transformed from a liability into a massive asset. It is the very mechanism that creates the opportunities you are waiting for. The panic and fear that drive down the price of a great company are what create the gap between price and intrinsic value. Without volatility, without these periods of irrational fear, great companies would always trade at fair or expensive prices. The moments of crisis are the sale events that allow you to build your position. When you have cash ready and a wish list of high-quality companies you've already identified, a market crash is not a crisis, it is a gift. It is the opportunity to deploy capital at unusually high rates of expected return. The financial impact of this is twofold. First, it allows you to lower your average cost basis on the world's best businesses. Instead of buying at fair prices during calm markets, you are concentrating your purchases during periods of turmoil, systematically tilting your long-term returns upward. Second, It prevents you from making the single most destructive financial error, selling at the bottom. By viewing volatility as an opportunity, you are psychologically inoculated against panic. You are no longer a victim of the market's swings, but a beneficiary of them. This change in mindset has a direct and profound impact on your long-term compounded returns. An investor who sells during every 20% market correction will see their wealth decimated over time. An investor who holds on will do well, but the investor who has the cash and the courage to actively buy during those corrections will achieve results that seem almost magical to the outside world. They are harnessing the market's emotional energy, its fear, and converting it directly into financial fuel for their own compounding machine. This is the ultimate financial alchemy, turning the market's greatest perceived weakness, its emotional volatility, into your greatest strategic strength. The final pillar of this strategy is perhaps the most overlooked, yet it is where the truly life-changing wealth is created. What happens Tinamed? The hurdle is cleared. What do you do once the panic subsides, the problem is solved, and the stock price has recovered? The answer separates the trader from the true investor, and it unlocks the full power of this approach. The goal of the one-foot hurdle strategy is not to get a quick pop in the stock. It is not about buying Amex at 35 and selling it at 60. The goal is to use the temporary problem as a rare opportunity to acquire a partial ownership stake in a magnificent compounding machine for a fair or even cheap price, and then to hold on for a very, very long time. To understand this, we must look at one of Buffett's earliest and most formative investments, the Washington Post. In the early 1970s, the Washington Post Company was a fantastic but misunderstood business. It not only owned the world-famous newspaper, but also several television stations and Newsweek magazine. The crown jewel was the newspaper, which had a near-monopolistic grip on the Washington, D.C. market. It was a business with a deep moat. But in 1973, the stock market was in the midst of a brutal bear market. On top of that, the Post was facing its own one-foot hurdle. It was embroiled in a labor dispute, and the political fallout from its Watergate reporting, while journalistically triumphant, created a cloud of uncertainty around the company. The market was nervous. The stock was cheap. The entire company had a market valuation of around $80 million. Buffett did his analysis and realized this was absurd. He calculated that the television stations alone were worth more than the entire market price of the company. You were essentially getting the Washington Post newspaper, one of the world's greatest media franchises, for free. It was a classic one-foot hurdle opportunity, created by a combination of a general market downturn and company-specific uncertainty. Buffett invested aggressively, putting over $10 million into the stock, a significant portion of Berkshire's assets at the time. The hurdle was soon cleared. The labor issues were resolved, the bear market eventually ended, and the Post's incredible reporting cemented its reputation as a national treasure. The stock price recovered handsomely. Now, here is the crucial part of the story. The trader, the speculator, would have sold after the stock doubled or tripled and banked their profit. They would have declared victory and moved on to the next idea. Buffett did the opposite. He held on for over 3 decades. He saw the purchase not as a trade, but as the beginning of a long-term partnership with a phenomenal business. That $10 million investment, through stock splits and decades of relentless business growth, compounded into a stake worth over $1 billion. The initial hurdle was just the entry ticket. The real wealth was created by sitting still for 30 years and letting the magnificent underlying business do all the heavy lifting. This is the ultimate lesson. Identifying and stepping over the one-foot hurdle is the event that gets you into the game. But the championship is won by letting the power of compounding work its magic over decades of uninterrupted ownership. You don't just invest in the problem's resolution, you invest in the decades of success that follow. The final promise of this strategy is not a quick profit. It is the acquisition of a lifelong wealth-generating asset at a price you may never see again. The temptation to sell a winner after a quick and satisfying gain is one of the most powerful and destructive psychological forces in investing. This behavior is driven by a combination of 2 potent cognitive biases, myopic loss aversion and hyperbolic discounting. Myopic loss aversion is a short-sighted version of the loss aversion we discussed earlier. When we watch our portfolios, we see the daily and weekly fluctuations. A stock that has doubled from our purchase price feels like a big win, and the thought of it falling back down and giving back those gains triggers our loss aversion in a powerful way. The pain of seeing a 100% gain shrink to an 80% gain feels like a real loss, even though it's still a massive profit. This myopic focus on short-term volatility creates a constant, nagging anxiety that can only be relieved by one thing: selling the stock and locking in the gain. This provides immediate emotional relief, but it often comes at the cost of enormous future returns. The second bias, hyperbolic discounting, is our brain's tendency to prefer smaller, immediate rewards over larger, later rewards. A guaranteed $10,000 profit right now feels much more tangible and attractive than a merely possible $100,000 profit 10 years from now. The future is uncertain, but the cash in your hand is real. This bias causes us to dramatically undervalue the immense power of long-term compounding. We cash in our chips too early, satisfied with a small victory, without ever stopping to calculate the massive jackpot we are walking away from. Buffett's decision to hold the Washington Post for over 30 years is a masterclass in overcoming these biases. He did not watch the daily stock price. He focused on the long-term health and profitability of the underlying business. He was playing a different game. His mindset was not that of a stock trader trying to capture price swings, but of a business owner participating in the long-term value creation of the enterprise. This requires a fundamental shift in time horizon. You must consciously fight the urge for the immediate gratification of a locked-in gain, and instead cultivate the patience to let your best ideas play out over a timescale of decades, not months. You have to be willing to endure the short-term volatility, the scary drawdowns that will inevitably come, to capture the truly extraordinary long-term rewards. This is why the one-foot hurdle strategy is so potent when combined with a long-term hold. You are not just getting a temporary mispricing, you are getting a permanent compounding machine. Selling that machine after a quick profit is like finding a goose that lays golden eggs and selling it after it lays the first one. The 99% take the egg. The master investor keeps the goose. So how can we operationalize this long-term mindset? How can we create a practical blueprint that helps us hold on to our winners and resist the urge to sell too early? We need a mental model for ongoing portfolio management. Let's call it the gardener versus carpenter mindset. A carpenter's job is project-based. They build a chair, and when the chair is finished, the project is over. They sell the chair and move on to the next project. Many investors treat their stocks like a carpenter treats a chair. They buy a stock with a target price in mind. When the stock hits the target, the project is finished, and they sell, looking for new lumber to build the next chair. A gardener, on the other hand, operates on a completely different timeline and with a different set of goals. A gardener plants a sapling. Their job is not finished when the tree is in the ground. It has just begun. For years, they must water it, protect it from pests, and give it sunlight. Their reward is not a one-time payment, but a tree that grows stronger and more fruitful every single year. A great business is a sapling. Your job as an investor is to be a gardener, not a carpenter. When you buy a wonderful company at a great price, you have not finished a project. You have planted a rare and valuable tree. Your job now is to hold it and let it grow. This mindset leads to a different set of questions for reviewing your portfolio. The carpenter asks, "Has my stock hit its price target?" The gardener asks, "Is my tree still healthy?" To apply the gardener mindset, you should conduct a periodic garden review of your holdings, perhaps once or twice a year. During this review, you do not focus on the stock price. Instead, you ask a series of simple questions based on your original moat mapping and one-foot hurdle analysis. First, is the moat still intact? Has anything changed in the competitive landscape that threatens the company's durable advantage? Second, is the management still excellent and acting in the best interests of long-term shareholders? Third, is the company still deploying capital intelligently, earning high returns on its investments? Fourth, Is the long-term thesis that I wrote down in my journal still valid? If the answers to these questions are all yes, then there is no reason to sell, regardless of what the stock price has done. It doesn't matter if the stock has gone up 100% or down 20% since you bought it. If the business itself remains a wonderful, healthy, growing enterprise, your job is to do nothing. Just let the compounding continue. You only sell. You only pull the plant when the answer to one of these fundamental questions turns to a definitive no. You sell the business, not the stock. By adopting this Gardner versus Carpenter framework, you shift your focus from the distracting noise of short-term price movements to the fundamental signal of long-term business value. It is the practical operating system for a multi-decade journey of wealth creation. The antithesis of the Gardner's patient cultivation is the path of the 99%, which is to treat stocks like lottery tickets. For the vast majority of participants in the market, the goal is not long-term ownership of great businesses. It is the thrill of a quick win. They are not investing. They are gambling. They buy a stock not because they have studied its moat or management, but because they heard a hot tip, saw it being hyped on social media, or simply noticed that it was going up fast. Their entire thesis is that the price will continue to go up in the short term, and they can sell it to someone else, a greater fool, at a higher price. This approach is completely divorced from the underlying reality of the business. The company's earnings, its balance sheet, its competitive position, these are all irrelevant details. The only thing that matters is the upward momentum of the stock price. This mindset inevitably leads to a portfolio that is constantly being churned. A stock is bought, it goes up 20%, and it's sold to lock in the win. Another stock is bought, it goes down 15%, and it's sold to cut losses. The investor is constantly jumping from one idea to the next, chasing heat and momentum. This behavior is disastrous for two reasons. First, it racks up enormous costs in taxes and commissions, which act as a constant drag on returns. Second, and far more importantly, it ensures that the investor never, ever benefits from the true magic of compounding. The eighth wonder of the world, as Einstein supposedly called it, cannot work its magic if it is constantly being interrupted. The process of generating wealth through compounding is a long, slow, and often boring process in the early years. It's only in the later decades that the curve becomes exponential and the numbers become truly staggering. The lottery ticket investor never gets to that part of the curve. By selling their winners after a small gain, they are constantly cutting down their saplings, just as they are beginning to grow into trees. They are perpetually starting over, planting new seeds, never allowing any of them to reach maturity. They experience the thrill of the occasional small win, but they sacrifice the life-changing wealth that comes from owning a truly great enterprise for a decade or more. The Gardner's path is less exciting on a day-to-day basis. There are long periods where nothing much seems to be happening, but beneath the surface, the roots are growing deeper, the trunk is getting thicker, and the potential for future fruit is compounding relentlessly. The lottery ticket player is focused on the next spin of the wheel. The Gardner is focused on the harvest of a lifetime. The direct financial connection between long-term holding and wealth is the mathematical certainty of compound interest. There is no force in the financial world more powerful, and a failure to harness it is the single greatest mistake an investor can make. Let's quantify the staggering difference between the Gardner and the Carpenter. Imagine two investors, both starting with $10,000. The Carpenter is a skilled trader. He finds a good investment, and it goes up 30% in a year. He sells, pays his taxes on the gain, let's say 20%, and reinvests the proceeds. He repeats this process every year. For 30 years, the Gardner finds a truly wonderful business, a See's Candies or a Washington Post, that is able to grow its intrinsic value by a steady but less spectacular 15% per year. She buys it and does nothing else. She never sells. She never pays taxes on the capital gain. She just lets it grow. In the first few years, the Carpenter might even be ahead. His 30% gains feel powerful. But the silent drags of taxes and the difficulty of consistently finding new 30% winners every single year start to take their toll. The gardener's investment, meanwhile, is growing uninterrupted. Every dollar of profit remains in the investment, generating its own profits the following year. After 30 years, the carpenter's $10,000, despite his impressive annual gains, might have grown to a few $100,000. A fantastic result, but the gardener's $10,000, compounding uninterrupted at 15% per year, will have grown to over $660,000. And if she found a business that could compound at 20%, her initial stake would be worth nearly $2.4 million. The difference is not just large, it is life-altering. This is the financial manifestation of the eighth wonder of the world. The unbroken chain of compounding creates a financial force of gravity that, over time, becomes unstoppable. The one-foot hurdle strategy is your key to this kingdom. It is the tool that allows you to buy these incredible compounding machines at a sensible price. But the real fortune is not made in the purchase, it is made in the patience. It is made in the discipline to hold on, to let the gardeners do their work, to allow the mathematical power of compounding to transform your initial investment into a legacy of true and lasting financial freedom. You have just invested a significant amount of your most valuable asset, your time, to master a powerful mental model. You have recalibrated your entire approach to the market. You are no longer a hunter of speculative lottery tickets or a hero trying to save a dying business. You have acquired the mindset of a connoisseur of quality, a patient opportunist who waits for the world's greatest businesses to be put on a temporary sale. You now understand how to distinguish a simple solvable one-foot hurdle from a complex wealth-destroying seven-foot hurdle. This tool alone, if applied with discipline, will protect you from the most common and catastrophic mistakes that plague the average investor and will dramatically increase your probability of success. But what you've mastered today is a single crucial piece of a much larger interconnected system of thought. The one-foot hurdle model is devastatingly effective, but it operates on an assumption that you already know how to identify a truly great business in the first place. Knowing how to step over the hurdle is one thing. Knowing which runner is a world-class athlete worthy of your backing is another skill entirely. The mental model you have just learned is like possessing a key to a vault, but the video that is now on your screen is the map that leads you to the vaults that are actually worth opening. It is the missing link, the next piece of the framework that connects the opportunity of the hurdle to the quality of the underlying business. It provides the tools to build the wish list of champion companies so that when the inevitable storms of market panic arrive, you are not just a survivor, you are a prepared predator. The journey of transforming yourself from a market participant into a master capital allocator is built brick by brick, mental model by mental model. You have just laid a powerful cornerstone. The choice you face now is a simple one. It is a question of identity. Are you a dabbler, content with a single piece of the puzzle? Or are you an architect, committed to building the complete mental fortress that will secure your financial future? The next brick in that fortress is on your screen right now. The choice to lay it is yours.